Welcome to the deep dive. Today we're plunging into a really fascinating high-stakes puzzle, ALT5 Sigma Corporation, ticker ALTS.
It's a really interesting one.
Yeah, and our mission with this deep dive is to, extract the most important nuggets from your sources. We've got a comprehensive expert report, market data, company filings, so you can truly understand what's unfolding here. Is ALTS like a visionary company on the cusp of exponential growth?
Or is it maybe just a complex, kind of unfocused entity struggling to find its footing?
Exactly. We're going to unpack why ALTS is a quintessential high-risk, high-reward special situation, definitely not for the faint of heart, and its whole future seems to be hanging on a pretty critical corporate maneuver.
What's really fascinating here, I think, is how ALTS presents such a challenging analytical puzzle. You got this microcap entity, right? And it's operating simultaneously at the bleeding edge of institutional cryptocurrency adoption and clinical stage pharmaceutical development.
Two worlds colliding.
Totally. And this impending plan they have to separate these two wildly different businesses into distinct public companies, well, that creates a classic special situation scenario. Could be a real unraveling of value or, potentially a disaster.
And just a quick note before we really jump in, all the information and market data we're discussing for ALT5 Sigma is current as of July 5, 2025. The reference share price we're using is $8.23.
Good context.
Also, a quick word from Stock Analytics AI, who commissioned this deep dive. If you're looking for priority deep dives on specific tickers, you can like and subscribe to their YouTube channel. $4.99 a month, members get priority access to deep dives.
And they're covering all of the S&P 500 stocks over the next few months, which is pretty ambitious.
It is. And if you just want a one-off deep dive on something specific, you can just drop them a super thanks on YouTube.
Okay, let's unpack this then. Chapter 1, Business Analysis, a tale of two companies. Our first big question with ALT5 Sigma is, well, what exactly is this company? Because if you look at how the market classifies it, it's a bit of a head-scratcher.
It really is. Our sources show a company that's gone through this radical transformation, pivoting from old legacy operations to this dual-track strategy. And the market itself seems genuinely confused. We see data providers listing ALTS under consumer discretionary home furnishings must be a ghost from its past.
Yeah, out of the very distant past, likely.
Alongside technology software application and pharmaceutical preparations. I mean, talk about an identity crisis.
And that identity crisis isn't just confusing, it's like a real problem. This classification ambiguity, it means the company is probably being overlooked by sector-specific institutional investors, and automated screening tools.
Ah, so it falls through the cracks.
Exactly. This contributes to market inefficiency, and it could mean the stock is completely mispriced. If we connect this to the bigger picture, the planned spinoff isn't just some strategic option they're considering, it's actually a necessary action to resolve this fundamental identity crisis.
Right, to let each business kind of stand on its own and be understood.
Precisely. Allows each business to be properly understood and valued by its own specialist investor base.
So, beyond the identity crisis, what are these two businesses actually doing? How do they plan to make money?
Okay, so ALT5 Sigma currently operates through two distinct segments. First up, there's the Fintech segment. This is ALT5 Sigma itself, the parent company for now. It runs on a business-to-business, B2B, crypto as a service model.
KHS.
Think of them as providing the plumbing for traditional financial institutions, banks, broker-dealers, merchants to seamlessly integrate digital asset services. Revenue.
Yeah.
Mostly from transaction fees.
Makes sense. What are the key products?
Well, they have ALT5 Prime. That's an institutional-grade electronic over-the-counter or OTC trading platform for digital assets. It's integrated with Broadridge Financial Solutions and YFX Gateway, which is a big deal in the institutional space.
Okay.
Then there's ALT5 Pay. It's an award-winning cryptocurrency payment gateway, mainly for merchants, and it offers automatic fiat conversion, which is key.
Very important.
And importantly, they acquired mSwipe back in Q1 2025. mSwipe is a payment solutions provider, and it creates this really crucial bridge between traditional fiat currency and crypto.
Got it. So that's the fintech side. What about the other personality?
Right. The second segment is the biotechnology segment. This is the part that's planned to be spun off as Alea Therapeutics. Now, this is a clinical stage biotech. It's focused purely on R&D for proprietary, non-addictive pain management drugs.
Pre-revenue, then.
Entirely pre-revenue. Unlike the fintech side, future revenue here is completely dependent on successful clinical trials and, critically, FDA approval. Their lead drug candidate is JAN123. It's aimed at complex regional pain syndrome, or CRPS.
CRPS. Yep.
And it has orphan drug designation from the FDA. That's a huge deal. It offers incentives like a potential 7-year market exclusivity if it gets approved. They're gearing up for a pivotal phase 3 study right now.
Phase 3, so quite far along.
Relatively, yes. They also have a second candidate, JAN101, for peripheral artery disease, PAD. But here's a really smart strategic element for both candidates. They're using the 505(b)(2) regulatory pathway.
Okay, what does that mean in simple terms?
Think of it like this. Instead of doing all the preclinical and clinical work from absolute scratch, which costs a fortune and takes forever, the 505(b)(2) pathway lets them leverage existing safety and efficacy data from drugs that are already FDA approved.
Ah, like building on previous work.
Exactly. It can dramatically slash the time and cost it takes to get a drug through the approval process. It's a very pragmatic, capital and time-saving strategy, especially crucial for a small biotech like this.
Now, despite being a microcap company, market cap around $144 million, our sources suggest the fintech segment has actually achieved some pretty impressive scale. That's quite something for a company this size, isn't it?
It absolutely is. It's processed over $5 billion in crypto transactions since 2018. Serves over 1,000 global businesses. I mean, that traction even led to his inclusion in several Russell indexes, which significantly boosted its visibility.
Wow, okay.
So the value proposition for fintech is clear. Be the premier B2B provider of compliant KS infrastructure. Take away the complexity. For biotech, it's developed non-addictive pain therapies, tackle the opioid crisis.
Looking at the industry picture, our sources indicate ALT5 is kind of positioned at the confluence of two industries with really powerful long-term tailwinds.
Exactly right. The market for institutional crypto infrastructure, KS, is projected for just explosive growth. You look at the global blockchain as a service market boss, which is a good proxy. It was under $1 billion in 2021 and projected to hit, well, tens of billions of dollars by 2031. That's a staggering compound annual growth rate, like 59.3%.
Huge growth.
And the crypto payment gateway market, also projected for substantial growth, maybe closer to 18–19% CAGR, but still very significant. And then, of course, biotech, specifically non-opioid pain management. Well, that has a massive market opportunity because of the ongoing opioid crisis.
Explosive growth sounds fantastic, but usually that means everyone else is trying to get a piece of that pie, too. Who are they actually up against in these two very different arenas?
Oh, absolutely. Competition is intense on both fronts.
Yeah.
In fintech, you've got giants like Stripe, which is making moves into crypto, plus established players like BitPay and Coinbase Commerce.
Heavy hitters.
Definitely. And in biotech, JAN101 faces the standard treatments for peripheral artery disease. JAN123, the lead candidate, competes with medical devices from big names like Abbott, Medtronic, Boston Scientific, plus, other efforts in non-addictive pain drugs.
What about the hurdles of regulation and actually building a competitive advantage? These seem like massive challenges in both spaces.
You've hit on something crucial there. The company has to navigate two incredibly complex regulatory frameworks. For fintech, it's the digital asset space, which is, evolving super rapidly. ALT5 holds money services business MSB registration in Canada and virtual asset service provider VASP registration in Lithuania.
Okay, so they have some licenses.
Yes, and those licenses are key assets, but they also come with significant compliance costs and overhead, and they are geographically limited. For biotech, it's the FDA, where that 505(b)(2) pathway and the orphan drug designation are really crucial regulatory strategies.
So the barriers to entry seem high in both.
Formidable, involving licenses, technology, capital. For microcap, building a truly sustainable competitive advantage is rare. But ALT5's potential moat, if they have one, comes from its unique assets. In fintech, maybe some early network effects, like their Odoo integration for payment services and the combination of its regulatory licenses and that integrated cost platform.
And
biotech is built on intellectual property. The patents protecting JN123 and that orphan drug designation with its potential for 7 years of market exclusivity. That's a big potential advantage if they get there.
Okay, Chapter 2, Management Evaluation. The quality of the management team feels absolutely critical in a special situation like this one. Our sources describe ALT5's leadership less like typical startup builders and more like seasoned financial engineers.
Yeah, what's fascinating here is their collective background. You've got Peter Tassiopoulos, the CEO since August 2024. He has over 30 years in M&A, capital markets, corporate restructuring. Over $1 billion in completed transactions under his belt.
Wow.
That skill set is perfectly tailored for things like the M-Swipe acquisition they just did, and critically, for executing this planned spinoff.
Makes sense.
Then there's Tony Isaac, chairman and president. He provides continuity, also has a background in complex business transactions. And Verlin Johnson, the CFO since 2017, brings over 30 years in high-level financial roles, specializing in turnarounds and SEC reporting. It really is a special situations team.
So it sounds like the investment thesis hinges as much on their ability to actually pull off the spin-off, the financial engineering part, as it does on the, operational success of the two businesses themselves.
That's a great way to put it.
But our sources also highlight a major concern. You mentioned a CFO with 30 years experience, specialist in turnarounds, SEC reporting, yet their 10K filing explicitly mentions material weaknesses in internal controls over financial reporting. Wait, how does that happen? That seems like a massive contradiction.
That's exactly the paradox, and you're right to flag it. It's a profound red flag for any public company. It basically means their internal checks and balances for ensuring accurate financial reporting aren't working properly.
Oh, so numbers might not be reliable.
Potentially, yes. It means their financial reporting might not be reliable, which is like trying to navigate a ship in a storm with a faulty compass. For investors, it means every financial number they release has this shadow of doubt over it. It could completely complicate or even scuttle the spinoff, make future financing a nightmare. It creates this paradox, as you said. Maybe it hints at issues stemming from the rapid acquisition and integration of the fintech subsidiary. Whatever the cause, it casts a huge shadow over financial reliability and introduces immense risk.
What about their capital allocation strategy then? Especially with this high-stakes restructuring on the horizon, how have they been using their money?
Well, their strategy has really been defined by this dramatic pivot. The acquisition of the ALT5 Fintech business was obviously the most significant decision. That was followed by the M-Swipe acquisition more recently.
Right.
The next major event is this planned spin-off of Alea Therapeutics. The goal there is clear: secure dedicated financing for the biotech side, and crucially, reduce the cash drain on the parent company.
Makes sense. Buybacks, dividends.
No history of share buybacks or dividends, which is totally appropriate given they're unprofitable, and focus entirely on this restructuring. Frankly, looking back, historical capital allocation hasn't generated value. You see that in the deeply negative return on invested capital, ROIC, of 19.9%. Yeah. So the entire bull case really rests on this restructuring, completely reversing that negative trend.
Okay, Chapter 3. Financial analysis. We've talked about the vision, the leadership, the strategy, but ultimately the numbers don't lie, right? What do the financials tell us about whether ALT5 is actually building something sustainable or just, trying to stay afloat?
You're absolutely right. And our sources emphasize that looking at historical financial data for ALTS is largely irrelevant for forecasting. Because of that fundamental break from the past after the fintech acquisition in 2024, we're really looking at a new company here.
Right.
Its market cap is roughly $143.65 million, firmly in microcap territory. Now, the revenue growth story is dramatic. After the old legacy business revenue basically fell to zero in 2023, the fintech acquisition generated over $12 million in fiscal 2024, and that was in just over 2 quarters of contribution.
Impressive start.
And growth has accelerated into 2025. Q1 2025 revenue hit $5.51 million. That puts the company on an annualized run rate of over $22 million. So this rapid top-line growth, that's the central pillar of the bull case.
Okay, top line looks good, but what about profitability?
That's where the picture gets complicated. While the fintech segment itself boasts pretty healthy gross margins, somewhere between 47% and 50%, the company's consolidated operating margin is a stark negative 43.92%.
Why such a big difference?
Mostly due to corporate overhead and, significantly, the pre-revenue biotech R&D expenses. Those are dragging down the consolidated picture. This is why the planned spinoff is so crucial. It would remove a major source of those losses from the parent company's books.
And cash flow?
Free cash flow, FCF, has been consistently negative. The price to FCF ratio is, well, sky high at 182.4. That indicates the market is pricing in a dramatic future improvement that frankly just hasn't materialized yet.
That sounds like financial stability is a really major concern then. Are we talking about a company operating on fumes here? Is the balance sheet okay?
It is arguably the single greatest risk, and yes, fumes isn't too far off. They're operating with a very, very thin margin of safety. The company has a multi-year history of significant net losses. The debt-to-equity ratio is 1.26. Now that's high, and it's particularly dangerous for an unprofitable company.
Okay.
But even more critically, the current ratio is 0.83. What that means is their current liabilities bills due within the next year exceed their current assets, like cash and receivables.
So they might not have enough liquid assets to cover immediate debts.
That's the risk it points to, yes.
Hmm.
Think of your personal bank account. If your bills due next month are more than the cash you have right now, plus what you expect to receive quickly, you're in a tight spot, right?
Definitely.
That's essentially what this ratio is telling us. For the company, they might struggle to cover their short-term financial obligations.
So putting it all together, negative cash flow, high debt, that low current ratio, what does this all mean for their actual survival prospects?
Well, it paints a picture of a company operating with a ticking clock. This financial fragility makes the swift and successful execution of the biotech spinoff and the rapid scaling of the fintech segment to profitability an absolute necessity, not just for growth, but for survival.
And if they need more cash?
The risk of future, potentially dilutive financings is extremely high. They'll likely need to raise more money, which could mean issuing more shares and reducing the value for existing shareholders.
Given all this complexity, how do you even begin to value a company like ALTS? Traditional methods seem completely useless here.
You're right. Valuing a company this complex, this transitional, is fraught with uncertainty. Standard metrics like price to earnings, meaningless because of the losses. A price to sales ratio, PS, of 7.9 is probably more appropriate given it's a growth story, at least on the top line.
But for intrinsic value?
For intrinsic valuation, a traditional discounted cash flow model is just not appropriate. You really need a sum-of-the-parts analysis. You have to value the fintech business and the biotech business completely separately, then add them together, maybe subtract corporate costs.
How would that work conceptually?
Well, for an educational model, let's say, for the fintech part, you have to assume pretty aggressive initial revenue growth, maybe 30–40% annually to start, and significant margin improvement, perhaps getting to 15–20% operating margins eventually. Big assumptions.
And the biotech side?
Biotech is a whole different beast. You typically use a risk-adjusted net present value or RNPV model. You'd estimate potential peak sales if the drug works, but then you have to apply probabilities of success for each clinical stage. Phase 3, failure rates are high, FDA approval isn't guaranteed.
So you heavily discount the potential value based on the risk.
Exactly. And you discount those future potential cash flows back to today using a very high discount rate, reflecting the almost binary nature of biotech R&D. It either works big or it's worth zero.
What kind of discount rate are we talking?
The weighted average cost of capital, or WACC, for both segments would likely need to be very high, probably in the 15–20% range, maybe even higher, reflecting all these substantial risks we've discussed.
So with all those assumptions,
Given the huge number of assumptions and the massive uncertainty, such a model might spit out a valuation range anywhere from, say, $4 to $18 per share. That incredibly wide range just underscores how sensitive the valuation is to your key assumptions about growth, margins, clinical success, and execution.
okay, let's shift gears now. Part 2, market dynamics and future outlook. We'll start with Chapter 4, market sentiment. Our sources reveal, maybe unsurprisingly, a study in contradictions for this little-known, complex microcap.
Yeah, what's fascinating here is this recurring analyst price target that pops up, $24 per share. That implies over 150% upside from the current price, carrying a buy rating.
Wow, $24. That sounds incredibly bullish given everything we've just discussed.
It does. But here's the thing. This appears to be a major outlier. When you look at broader platforms like TipRanks, they assign an underperformed score. Morningstar considers it fairly valued.
So a huge divergence. Where's that $24 likely coming from?
The divergence strongly suggests that the $24 target likely comes from just a single, or maybe a very small number, of boutique research firms. And it's quite possible they might have been compensated for providing coverage that's a pretty common practice for microcap companies trying to get attention.
Ah, okay, so it doesn't represent broad Wall Street consensus at all.
Not even close. ALTS is effectively what you'd call an orphan stock. It lacks mainstream analyst coverage. Now, that's both a risk, you get lower liquidity, less scrutiny, and a potential opportunity if the bull case actually materializes and catches the market by surprise.
Interesting. So this lack of big analyst coverage is kind of a double-edged sword. What about recent news flow? Has that helped shape a narrative?
The news flow itself has been predominantly positive recently. It's mostly focused on management actually executing parts of their plan. The MSwipe acquisition, reporting that strong quarterly revenue growth, announcing the spin-off plan, getting included in those Russell indexes.
So building a story of positive momentum.
Exactly. It has created a narrative of positive momentum around their strategic pivot, at least based on company announcements.
And are there any technical indicators from the charts that stand out?
Well, short interest is relatively low to moderate. Depending on the source, it's around 4.5% or maybe closer to 2.3%. Either way, it indicates there isn't widespread heavy short selling betting against the stock right now.
So probably low risk of a short squeeze.
Yeah, the days to cover ratio is around 2.8, suggesting a low risk of a short squeeze. Technically, though, the stock has shown strong momentum recently. The share price we mentioned, $8.23, is over 6% above its 50-day moving average and a pretty substantial 68% above its 200-day moving average. So from a pure chart perspective, that suggests a bullish trend, at least in the recent past.
All right, Chapter 5, Ownership Structure. Let's explore who actually owns ALTS, because that structure can have really significant implications for things like volatility, governance, maybe access to capital. Who are the key stakeholders in a company like this?
Yeah, that's a key question for any microcap. And for ALTS, institutional ownership is exceptionally low, somewhere between 7.7% and 8%.
Very low. Who are the main holders?
The largest holders are names like the Vanguard Group, Geode Capital Management, but these are primarily passive index fund managers. Their ownership is basically automatic because ALTS got included in those Russell indexes. It's not based on active fundamental investment decisions saying, we love this company.
So it provides maybe a baseline of liquidity, but it's not really a vote of confidence from active managers.
Exactly. It doesn't signal strong institutional conviction.
What about insiders? Management earning shares?
Insider holdings are also relatively low. Figures range between 2.4% and 4.8%. The CEO, Peter Tatsiopoulos, holds about 2.4%, but a chunk of that is restricted stock units, RSUs, granted as an inducement to join.
Okay. Any recent buying?
There has been some, yes. While the overall percentage is small, there were some open market buys recently. CEO Tatsiopoulos bought 5,000 shares last September. CFO Verlan Johnson bought 3,000 shares in December. Small buys, but still, those are generally seen as encouraging signals of management's own confidence.
Okay, better than selling. So if institutions and insiders own relatively little, who owns the rest?
Well, here's the kicker. Ownership concentration is highly diffuse and fragmented. Nearly 90% of the stock is held by the general public and retail investors.
90%. Wow.
Yeah. There are no large concentrated positions held by activist investors or major funds that might push for change or stabilize the price. And that high retail ownership contributes significantly to the stock's potential for high volatility. Retail sentiment can swing quickly.
This leads us perfectly into the critical piece, risk. Chapter 6, Risk Assessment. Our sources absolutely underscore that an investment in ALT5 Sigma carries an exceptionally high degree of risk. Let's maybe do a comprehensive SWOT analysis here: strengths, weaknesses, opportunities, threats.
Okay, sounds good. This is really where you see why it's such a high-stakes proposition. Let's start with strengths. You've got that dual strategy in high-growth, potentially uncorrelated sectors, fintech and biotech. Proprietary fintech platforms that have proven transaction volume, those key regulatory licenses they hold. The patented biotech asset, JAN123, with that valuable FDA orphan drug designation. And, as we discussed, an experienced management team seemingly suited for this kind of restructuring.
Okay, some definite positives there. What about the flip side?
The weaknesses.
The weaknesses, W, are significant, and we touched on them. Top of the list. Those critical material weaknesses in internal financial controls. That fundamentally undermines reporting reliability. Then there's the highly precarious financial position, unprofitable, burning cash, high leverage, poor liquidity. It's a tough spot.
Right.
Also, arguably, a lack of strategic focus trying to manage two wildly different businesses simultaneously. And finally, that low institutional ownership, coupled with a high reliance on potentially volatile retail investors. Okay, big weaknesses. What about the opportunities? Where's the potential upside?
The opportunities, are definitely there. That's the allure. Explosive growth potential in CAW and institutional digital assets if they execute well. The potential for a significant value unlocking event with the spinoff of Alia Therapeutics. Positive clinical trial data for JAN123 or JAN101 would obviously be huge. And maybe increasing regulatory clarity for crypto over time could benefit the fintech side.
So, big potential if things go right. Now for the threats.
And the threats
Yeah.
are formidable. Intense competition, often from much larger, better-funded players in both fintech, Stripe, BitPay, and biotech. High volatility inherent in the cryptocurrency markets impacting the fintech segment's transaction volumes or sentiment.
Regulation.
A huge one. The evolving, uncertain, and potentially restrictive regulatory landscape for digital assets globally is a constant threat. There's also the significant risk of cyber attacks, especially for a fintech platform. Macroeconomic headwinds, inflation, high interest rates making capital more expensive are a big threat for a cash-burning company.
And you mentioned geopolitical risks, specifically tariffs.
Yes, specifically the 2025 U.S. tariffs.
Huh.
Those pose a real threat, particularly to the biotech supply chain for ALT therapeutics.
Let's dig into that spin-off execution risk again. Pulling off such a complex corporate maneuver, especially for a microcap that already flagged financial weaknesses, it just sounds incredibly challenging. What are the specific hurdles management faces just in executing this separation?
Oh, it's huge. It's not just a legal filing exercise. It can
Yeah.
be an operational nightmare if it's not executed perfectly. They have to untangle shared resources, IT systems, administrative staff, maybe even facilities. They need to allocate existing debt and assets fairly between two completely different kinds of businesses.
Tricky.
Very. Then they need to secure separate and adequate financing for each new entity. The new ALT therapeutics will need funding from day one. And they have to ensure both businesses can stand on their own operationally right away without disrupting the fintech business or the ongoing clinical trials.
And if they stumble?
Any misstep, significant delays, unexpected costs, maybe a poor market reception for the new biotech entity when it lists, could severely impact the parent company's already fragile financial situation. I mean, for every successful spin-off story you hear about, there are probably many more that fall apart or fail to deliver value.
Yeah.
And doing this with those internal control weaknesses, it's like, as you said, flying a plane while trying to fix the engine mid-flight. Extremely risky.
And speaking of those external threats, how exactly do macroeconomic factors like inflation and interest rates impact ALTS, specifically because it's burning cash and needs financing?
Yeah, as an unprofitable company that relies on external financing, ALT5 is highly sensitive here. Persistently high inflation and elevated interest rates pose a dual threat. First, they directly increase the company's cost of capital. It just makes it much more expensive to raise the debt or equity they likely need.
Right, borrowing costs go up.
Exactly. And second, from a valuation perspective, higher interest rates translate directly into a higher discount rate, that WACC we talked about. Using a higher WACC directly reduces the calculated present value of any potential future cash flows, which lowers the company's theoretical intrinsic value. So it hits them on both fronts.
And those 2025 U.S. tariffs, you flagged that as a specific threat, especially for the biotech side. Can you elaborate?
Yeah, it's a direct and potentially material threat, particularly to the biotech segment, ALT therapeutics. The U.S. biotech industry is surprisingly deeply integrated into global supply chains. Something like 90% of U.S. biotech companies depend on imported components or materials.
I didn't realize it was that high.
It is. So these tariffs are expected to cause significant disruptions and cost increases. First, obvious one, increased manufacturing costs. Tariffs on raw materials, specialized equipment that will directly raise production costs for making clinical trial materials and eventually commercial drugs if they get approved.
Second, supply chain disruption. Finding and validating new suppliers if your current ones are hit by tariffs. That's a lengthy, expensive process. One survey showed 80% of firms estimated they'd need at least 12 months to secure and qualify alternative suppliers. For a small company like Elia, that kind of delay could severely impact clinical trial timelines and R&D progress.
A year delay could be fatal for a small biotech.
Potentially, yes. And third, delayed innovation. If costs go up significantly and the supply chain becomes unstable, they might be forced to reallocate resources away from crucial R&D just to manage the logistical headaches, potentially postponing drug development timelines. So this geopolitical development adds yet another layer of significant external risk specifically to the biotech assets valuation.
Okay, Chapter 7, Conclusion.
So after digging through all of this, what does it all mean? It really feels like the investment case for ALT5 Sigma is, as we said at the start, a truly high-stakes proposition. Quintessential high-risk, high-reward special situation. Definitely not suitable for conservative investors.
Absolutely. The entire outlook hinges really on management's ability to navigate this incredibly complex corporate restructuring while simultaneously scaling in a new business in a very volatile market and advancing a risky biotech pipeline.
Let's summarize the bull case again. What has to go right?
The bull case is predicated on management executing a clear strategic plan to unlock shareholder value. They've decisively pivoted into these two sectors, KIDS and non-opioid pain relief, which both have potentially massive secular growth trends behind them. The plan to separate them, it seems logical, probably necessary.
In the businesses themselves.
The fintech segment is a rapidly growing business right now. The $22 million plus annualized revenue run rate, strong gross margins near 50%, over 1,000 customers, a key strategic partnership with Odoo. There are real operational achievements there. The biotech strategy, while obviously risky, seems pragmatic using that 505(b)(2) pathway, focusing on a lead asset, JN123, that already has orphan drug designation. If they pull all this off successfully, the stock, which is currently orphaned by Wall Street, could see a significant re-rating upwards.
Okay, that's the dream scenario. What about the bear case? The nightmare.
The bear case is equally compelling, maybe even more so right now, and it centers on those profound financial and operational vulnerabilities. ALTS is, frankly, in a precarious financial state. Unprofitable, burning cash, weak balance sheet, high debt to equity. Its survival likely depends on accessing more external capital, which means ongoing dilution risk for shareholders.
And the big red flag.
And the huge red flag, that public disclosure of material weaknesses in internal financial controls. That cannot be overstated. Then there's the massive execution risk associated with the spinoff itself and continuing to scale the fintech business profitably. And finally, all those formidable external headwinds we discussed. Intense competition, crypto market volatility, the new U.S. tariff regime hitting the biotech side, and the inherent uncertainties of clinical trials.
So based on the numbers, the risks, the potential, where does that leave the current stock price? You gave a wide valuation range earlier.
Yeah, our sum of the parts intrinsic valuation, which again carries a very high degree of uncertainty given all these moving parts, suggested a range of maybe $4 and $18 per share. The current share price of $8.23 falls within the lower half of that very wide estimated range.
Just tell us.
It suggests the market is pricing in some of the potential upside, but also acknowledging the significant execution risk and the financial fragility. The substantial gap between the current price and the upper end of that range really reflects how much needs to go right. Potential for significant appreciation relies heavily on successful execution and navigating all those threats. Conversely, any major failure, the spinoff falters, fintech growth stalls, trials fail, financing dries up, could easily see the price trend towards the lower end of that range, or potentially even below.
This deep dive into ALT5 Sigma Corporation truly highlights that tension, doesn't it, between potentially immense growth and just significant financial and operational hurdles.
It really does. And this raises, I think, an important question for you, our listener. Given those critical material weaknesses in internal controls sitting alongside a rapidly scaling fintech business and a, let's say, de-risked biotech pipeline, what stands out to you as the single most important factor that will determine ALTS's future? Is it fixing the controls? Executing the spinoff flawlessly? Fintech growth? Biotech success? It's a complex equation.
Definitely something to think about. We hope this deep dive gave you some real aha moments and useful context. If you do want more custom-tailored insights like this, remember to check out Stock Analytics AI. Their $4.99 a month members get priority deep dives on any S&P 500 stock.
And they're covering all of them over the next few months. Or for a one-off deep dive, you can just drop them a super thanks on their YouTube channel.
All right, and as always, please remember our standard disclaimer.
Yes, this analysis was generated by an AI system based on the sources provided. It's intended for educational and informational purposes only, and should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Thanks for diving deep with us today. We'll be back soon with another fascinating topic.